Good afternoon, everybody. Welcome to our final webinar of the year on the Premium Asia Income Fund. So we thought it was quite timely to have a presentation and a Q&A sort of discussion presentation with Gordon Ip, our CIO in Hong Kong, around the current conditions of the Asian fixed income markets. Obviously, it's been quite tumultuous since sort of July with the impacts on the property sector, other government intervention in certain sectors, and it's really been, welcomed to a greater or lesser extent, especially as the government is going down its Chechang plan of common prosperity. So as we sort of sit here today, the government has outlined a great many plans for the future. And today we're going to talk through some of those, and more specifically, I guess, directed at the property sector. And so you can see on the screen, I've got Gordon Ip with us, our CIO. But before we jump into sort of some Q&A questions, I'm going to just share my screen now and talk about some of the current updates around Value Partners. So just to confirm that today's presentation, while being recorded, is not personal advice, and everything that we talk about today is of general advice only. So if you would like more information that is not factual in nature, please reach out to your financial advisor. So just to keep everyone updated, Value Partners today is still managing around $11 billion, split effectively $4 billion fixed income with the remaining in equities. They've won over 200 awards in their time since their launch in 1993, and being one of the most transparent fund managers in Asia, because they are the only listed asset manager in Hong Kong, gives them a sort of a level of credibility that others simply cannot enjoy. And with the headquarters in Hong Kong, we're also one of the rare teams that have very extensive offices right across Asia and mainland China, which gives us the ability to be on the ground looking for the best opportunities for you, both from equities and fixed income perspective, which is why we've been able to generate the performance outcomes that we have for our investors. So just like our equity funds, Gordon also employs a value approach to investing in fixed income. And Gordon always says that there's never such a thing as a bad bond. There is only a bad price that you pay for it. So, in the current environment, there are opportunities, which Gordon is going to talk about a little bit later. And, the ability to fish and having the ammunition to be able to fish is critical at this point in the cycle. So Gordon's team is very extensive, 11 members in total. A new person has joined the research and strategy part of the investment team, which is really simply bolstering the team's ability to do more on the ground research and present more ideas to the portfolio management team that you see on the left-hand side there. And so the strategy primarily is made up of a very diversified portfolio of high yield debt instruments, all of which are senior secured, and all are bought in hard currency or US dollar. So we don't try to play multi-currency. We're not trying to complicate things for investors. We're trying to generate a 6% distributable income to investors over the long term, which we've successfully done so since the launch of the strategy in 2011. And to date, within the strategy now, our own family here in Australia has $7 million invested capital in this strategy. And, when we see the current sort of opportunity set, we also look to top up our investment because what I'm about to show you can be quite shocking, but at the same time, it also presents that opportunity set, which we believe looks a little bit similar to the GFC, but more specifically targeting the sort of the Chinese debt situation. So we build a very well diversified portfolio. We're ranking sort of 1,200 bonds in our universe and sort of screening them to pay us at least 6% as part of a diversified put together portfolio. And then Gordon's team starts doing the active monitoring and then the bottom-up credit analysis to form that portfolio. We stress test the portfolio every month through liquidity stress testing. And obviously our middle office also sits very primarily there to ensure that we sit within our mandate requirements. With regards to our credit research process, and I'm going to get Gordon to speak a little bit more about this later on, where we get into sort of deep dive in some of the questions, because there's been some enhancements that's made given, you know, the level of volatility we've seen in the market, and so Gordon's going to talk about that in a minute. There's some very, very interesting factors that we're now including. But what you can see here in terms of our scorecard is that it's ranked out of 5 every investment. We don't just simply, you know, pluck something out, you know, off the market and say this looks interesting. We go through a very deep process, and depending on what we're trying to achieve, and you can see here in the top right hand side, the strategy is critical to see how heavily weighted company fundamentals versus investment risk reward versus the market liquidity and momentum is. So, you know, we have a choice of investing into any bond as a tactical trade, a capital gain opportunity, or long-term yield hold, and that will determine the weighting of these underlying 3 factors. So it's very important for us to really understand the crux of the company. What we really don't care about is external research houses and what's happening inside China with regards to those 3 major research houses, and the way that they've been derating bonds in the market at the moment has also presented some fascinating opportunities for us. So the yield situation is no different than it is 12 months ago or even 24 months ago. Clients and investors alike and advisors are still yearning for yield. But how do you generate the diversified portfolio of yield? And sort of even more recently, one of the critical questions that have come up in conversations with advisors, and I sit on a number of dealer groups, investment committees, consulting to them about income and how to generate income, is this whole concept of capital stability. Going forward, and the question I ask all of you on the call today is, how critical is capital stability to an income portfolio? Because the fact of the matter is that, as you know, retail financial advisors, we have many clients that hold investment properties. And let's say that investment property yields them $1,500 a month. Now, from their perspective, they don't think there's any capital volatility. But the reality is, as we all know, if you value that property every day, there is capital volatility, and the capital just doesn't stay at a stagnant point in time. So in the same way going forward, if the market is challenged, and if we're staring down the risk of capital loss on traditional fixed income products, and you have to be very, very mindful of this, how is that going to convert going forward in terms of how you build that diversified income for your clients to give them something that is genuinely higher than cash, genuinely higher than term deposits, and government bonds, even at a cash yield level? Because what you see on the screen here, ladies and gentlemen, is that this is just the cash yield before taking into account the capital loss. Okay, so we've always, you know, espoused ourselves to try to find 2 different ways to win for your clients. The first is picking up an attractive yield, but second of all is to find ample amounts of capital gains for our clients, and that's what we're currently sitting in the current environment being. Now, what you also see now, and this is something we're going to do a deep dive on, is we're currently sitting on a 5-year average. We are now at a 6 standard deviation level spread with regards to where China high yield bonds currently sit. Now, for those of you that, you know, recall last year in March, the fund in the month of March, just like any other fixed income fund, because of the liquidity issues in the market, there were simply no buyers. Our fund recorded a negative 7% return for the month of March. And you can see there that at that point, we were higher than 4 standard deviations. Now, if we go back to statistics 101, 3 standard deviations on a normal distribution curve covers 99.7% of all possible outcomes. At 5 standard deviations, it only represents 0.0006% of all possible outcomes, and we're now at 6 standard deviations. And so we're looking at a current environment where things are looking like sort of a GFC style environment. But as we know, never ever underestimate the power of the Chinese government to stabilize the financial system. And again, I have a question for Gordon on that a bit later on. Our long-term track record still stands very strong. We have a total, including of the end of October figures, we still have generated over 8.5% net of fees to clients. And one of the sort of the questions that we've been asked more recently is with regards to looking at, let's say, the last 1 month performance. Okay, so you see on the 1 month performance, the fund has dropped 6.85%. Now that's all mark to market. Okay, and there is no defaults in the portfolio. Now, some investors, especially retail investors, may come to you, for those on the call that are advisors and are getting questions from clients about this, is that if the fund has fallen 6.85% in the last month, that means that's wiped out a whole 12 months at least of distributions for me. That's actually not true, and that's something that you do need to explain to your clients, because the movement in the capital value, as I said, has no relevance to the actual yield being paid, because the yield being paid right now, even as defensive as the current portfolio stands, is still over 600 basis points, which is our target, and that's with sort of 18% cash in hand at the moment. In the same way, for those investors that got in at the end of March last year and achieved just under 16% net returns for the 12 months ending March this year, in the same way, you didn't gain the next 2 years worth of distributions. It is all, fundamentally based on the capital gains that was made. So we still have managed to keep our volatility low. Remember, our volatility target is 7 to 8% over the long term. And even with the current bout of volatility, our volatility still is only just slightly above 600 basis points. We're very, very comfortable with the way the portfolio is positioned. And again, that's something we're going to talk about a bit later. Our consistent performance over the longer term is heads and shoulders above the benchmark, as well as the broader universe. Obviously, year to date and 1 year, because of the relative severity of the corrections, especially within Chinese high yield. Obviously, we've fallen to second quartile over a year or the bottom quartile. Again, that doesn't phase us, but again, going back to that 6 standard deviation chart, that's where we see the opportunity set coming up. And our downside and upside capture still remains very, very strong and very, very attractive. So here, I'm going to stop showing the screen for a minute because I want to sort of focus everyone on a larger screen of me and Gordon, I guess. So Gordon, welcome. Thank you for joining us this afternoon in Australia for most of us, and good morning to you in Hong Kong. Now, obviously, we're now trading extreme levels of uncertainty, which is reflected in that 6 standard deviation chart that I showed earlier. I mean, Gordon, what triggers are you looking for to see some normalcy come to the market, and how do you read a 6 standard deviation event? Because it's extreme, right?
Yeah, this is a very good question. As you have pointed out before, actually, from my experience, I've been investing in this market for more than a decade now, and I gotta be honest with you, what we are seeing today, as far as Chinese property market is concerned, it is really unprecedented. Okay, and therefore that's why you see that 6 standard deviation in terms of spread widening. So right now, although the market is cheap, I think one cannot just make decisions solely based on looking at numbers and chart. Now, obviously, the market is really, really, really cheap right now, okay? But I think the key point is to understand why the market has become so cheap and try to make sense, all the factors, and then make your decision that way. So what I'm looking at right now is basically we need to look at the macro policy by the Chinese government, specifically on the Chinese property market, the physical market. What we have seen so far this year is what I interpreted as a turbocharged detox program, okay, on the Chinese property sector. If one has the memory and basically rewind back memory, say 5-6 years ago, when the property market was really booming and all these developers are making a lot of money, and the previous generation of Chinese leader has pumped in lots of liquidity, and therefore a lot of these free capital find their ways into the property market, plus also other sort of quote-unquote speculative investment, both within and outside China, because there has been simply a lot of liquidity in the system, basically from the previous generation of Chinese leader. So fast forward when Chairman Xi Jinping came to power, one of his priority was to deleverage the entire system, and property sector definitely is one of them. It's just that we have COVID and also the US-China trade conflict, and that basically put this deleveraging exercise temporary on the back burner. Okay, so once the Chinese economy came out of COVID and the economy restart, and the economy is better positioned, and then all these deleveraging exercise came back, and basically what we have seen, for so far this year. And this time, I think, unlike the previous generation of Chinese leader, the Xi Jinping government, at least to our view, we think that they have been actually very determined to really bring in the leverage in the system. So therefore, investors see the 3 red line restriction and also other restriction on mortgage front, on land sales, on the rules of governing use of proceeds from down payment. All these basically is all is part of the package of really tightening on the Chinese property sector. Okay, so to answer your question, what trigger we are looking for is basically, okay, we need to see some sign of relaxation on any or all of these aspects, in terms of tightening. I mentioned they have been tightened mortgage approval process. Okay, mortgage approval in the sort of normal day usually takes, say, a few weeks. Nowadays, probably take months to do. Okay, mortgage as a portion to bank lending has been capped. Okay, the government also has limit on the price of a certain piece of land can be sold, and also they have a price cap on an apartment or house could be sold. So basically, they control the price, they control the supply, they control the demands, they control everything. Okay, so I think we need to see some sort of relaxation on any of all of these front. And recently, to be honest with you, we have observed that some region, some cities in China, we're starting to see some relaxations on mortgage approval. Okay, so mortgage approval has actually become a little bit faster, not much faster. And also recent news that the government will encourage more prudent sort of lending to developers. So we see some sign of relaxation, but I think I'm not going to sugarcoat it. I think I got to be honest with you. That's the major tone of the Chinese government right now is sort of still more tightening bias. Although we will see some slight adjustment in terms of relaxation here and there, and I think that will help to stabilize the market. Yeah. So right now, so it's basically a exercise. Okay, is that the market is really cheap. We see some sort of relaxation. I think right now is a market that if investors want to invest in this space, I do not suggest that they just blindly put money on every name in the property sector. It is a market, is all about issue selection and issuer selection, and not to be able to overly expose to all the issuer in the market. And I got to be honest with you that I believe that there could be other default or pending default or stressful environment coming for some of these developers in the market, but not all of them.
So to also be very clear with everyone on the call today and contextualize, our portfolio, we only have 15% of the portfolio in the property sector, even though we're talking quite a lot on the property sector, and that's very important to remember. The portfolio is very, very well diversified, and when we were very, very positive on the property sector, yes, our weightings were significantly higher. But, as times change, as government policy changes, and, whether it be equities or fixed income, if we've learned nothing else over the last 12 months, government policy plays a big deal in the way that we look at companies. The issue is that, separating sort of the investment process and the level of stringency that we have in our investment process in Asia, being on the ground, really has separated the men from the boys. So global investors investing in Asia or China versus local people investing in Hong Kong, China has derived very, very different outcomes for investors. Now, Gordon, going sort of, we've seen the problems with Evergrande, and they're the second largest player in the market, right? If as the government continues this tightening process, and they're very, very determined to deflate the property market in a material way to create more social stability, and also, the aim of common prosperity. Are you looking more at big players at the moment for opportunities, from a security selection perspective, or is it, looking further down, lower quality names as defined by major research houses?
That's a very good question. Our strategy in the property sector is like this. We have a sort of so-called barbell strategy. In one hand, in this environment, we tend to overrate the more established name, meaning the double B, okay? Because those guys has more chance to be the ultimate survivor, after all said and done. However, on the lower rated credit, as I said, not all developers are created equal, and there are some very good companies that got dragged down by the current turmoil in the market. So on the lower rated, we have select a handful of names that we believe they also have high chance to survive, although they are going through some tough time right now. So again, it's all about buying names, not buying market. You can still hate the market, but in this kind of stress environment, there are indeed cheap bonds you can buy.
Yeah. We talked about this sort of last week, Gordon. Given the situation, how do you see this as an opportunity for investors to get in? And I think the question, that you shot back to me is, depends on the time horizon, right?
That's very true. Because if you observe the price action, for the past 2-3 months, there are days that bond up 10, 15 points on one day, and then the next day it's down 7, 8, and then up another 4, 5, and then down another 10, 20, right? So this kind of environment is really volatile. Okay. Although I mentioned there are cheap bonds you can buy, but I think it's fair to say that investors, if they put money right now, they have to prepare to leave this money on a relatively longer term horizon, meaning 6 months or above, because we believe that volatility will still stay at a relatively elevated level for the coming quarter, at least 2 quarters. And then when all said and done, that's when we see the blue sky. Right now, we are still going through the storm.
I think we're lucky, culturally in Australia, we don't have short-term investors. 6 months is a very, very short-term time horizon. So I think we'll be quite safe from that perspective.
I deal with a lot of short-term investors in this part of the world.
Yes, correct. Now, a question has come through, Gordon, and it is sort of linked to the 6 standard deviation question we were talking about just then. So the question is, at current high yield spread levels, what degree of default is priced in relative to historical averages?
Okay. Obviously, the Asian default rate has actually been a little bit higher on page 24 of the slide, right? So as you can see, Asia default rate has been trending lower than comparable US high yield. But again, I have to be honest with you that these number has not counted Evergrande. Just on the record, Evergrande has not officially defaulted yet,
Correct.
So they cannot count it as default. Okay,
Correct.
But if Evergrande actually defaulted, okay, which we think that there's still possible, the default rate on the on the Asia high yield will have to short all the way up to double digit. Okay.
Yep. Yep.
Yeah. But also, this is also one thing that the Chinese government cares about. So therefore, the Evergrande situation, we will have to just wait and see. In my heart, there's a small corner in my heart that leads me thinking that maybe Evergrande may never default, even though it's continued to be stressful. There's a very small chance that the Chinese government will just let it deflate, and then just let time passes so that the market will tend to forget about this name, and then eventually it will let them go. Yeah. So yeah.
We'll come back to the property sector as a whole, but I guess where I also want to sort of have a discussion with you, and I think it's sort of very beneficial for our investors, is that given that even while it's 15% of our portfolio now, it's materially dropped a lot compared to 12 to 18 months ago. Has there been any enhancements to your process? I mean, it was already very strong, and the deep credit research is what we pride ourselves on. Has there been any enhancements to your process with regards to ensuring that us as investors are getting our coupon payments, and B, the repayment of principal? Because there are some sort of murky situations, I think, that you alluded to when we caught up last week.
Yeah, I think that's a very good question. As I mentioned, today's market is basically unprecedented. So it's in a way abnormal for as far as I can see from my past experience. So abnormal market also need to do something more above and beyond the normal level of in terms of we do due diligence and also how we scrutinize all these companies. So I mentioned right now the government has really cramped down on this sector and limiting how much this company can borrow and how they use the cash. Okay, so give you an example, right? So right now we are paying a lot more attention to the cash situation. For example, right, if a company balance sheet report, let's say $100 million of cash on their balance sheet, in the old days, people just take it for granted, and then not question about are these cash restricted or unrestricted, or how it's going to use, and all that, whether it's onshore or offshore, because in China there's a capital restriction of we're meeting money coming in, money coming out of China, right? So, but today we scrutinize this cash position not only on the overall amount, but we also really drill down on, okay, first of all, how much is restricted, how much is free, and how much this cash is sitting inside China and how much it is sitting outside China, because there's a fundamental difference, right? Even you have cash inside China, you may not be able to remit out. So as far as offshore bondholder is concerned, the cash is there, but we couldn't touch it, right? And also, I also mentioned that these days when company sell a house, sell a flat, the down payment from the home buyer, in the old days, the company have the option to relocate and use it for other corporate use. Nowadays, no longer. All those down payment should be tied to that specific project that the buyers actually buy into. Okay, so all these basically lead us to go above and beyond on how we scrutinize the cash situation. So that's the liquidity. And also on the debt side, we follow right now basically project by project of this company, and also maturity to maturity from all the debt obligation, whether it's loans or bond or trust product. We basically laid it out, and to us, this is basically becomes a daily process now.
Are you seeing that there's still asset liability mismatches, especially with regards to timing, that they have a piece of debt, or they've got some bank financing, or they've got a trust product out in the market where they're clearly, the project's not going to be complete and it's going to be due and payable, and that's going to create more stress on a lot of these companies? Is that sort of what you're referring to?
Yeah, there are cases right now, they still have mismatch between their maturity profile and liquidity. And that's why you are still seeing a 6 standard deviation valuation right now. So yes. The entire sector, to be very honest, is not out of the wood.
Yep. I mean, how likely is sort of turning back to the sector itself? I mean, how likely is it that the government will step in to prop up ailing developers? Because you know they're sort of the government is very aggressive at deflating it. We talked last week, and you said there's unlikely that we're going to see too much loosening or change in stance till at least Chinese New Year, because they're just so determined, right? I mean, is there any sign the government may actually step in, or there's still not?
I still stand on my previous conclusion that it's unlikely the government will actually step in to help, especially the private-owned enterprise. SOE maybe, because we have seen, right, for example, Huarong got paid out. So SOE maybe, POE very unlikely. I think it's especially, this statement is especially strong is under the current, the so-called common prosperity, right? You may have heard of it from some of the Western media, that China is trying to narrow the rich poor gap. And for the owner of a lot of these private-owned enterprise in the property company, many of them they are very rich people, and some of them has actually gone up to the top 10 at some point in history. They're the most affluent citizen inside China. So using public money to bail out private enterprise doesn't really sit well with this common prosperity theme. And also, again, the government really is determined this time to detox the entire sector, right? So I still don't think that there will be any large scale sort of government type bailout to POE. So that's why market understand it. So that's why we are still trading at 6 standard deviation.
I think it's also important to make it clear that we're talking about the government is aggressively detoxing, not destroying the property market, because those are two very different conversation points. There is simply no motivation for the government to destroy the property sector. People still need to find places to live. They still need to find ways of growing their wealth. Would it be fair to say, Gordon, that after all, the 3 red line rule that came in, banks not offering the same amount of leverage to developers going forward because they don't want to be blacklisted, obviously. I mean, does that lead to a more sustainable property sector in the future? And this is why the government is so aggressive?
Definitely, I think definitely. Right now, I think if I project my horizon, let's say 2-3 years down the road, what I see or I expect to see is that as a property company, right? If you are POE, a developer, one of the things they may turn into eventually is to basically become a pure contractor. Okay, they build houses and flats for bigger player, meaning the SOE or the biggest of the biggest POE. Okay, the smaller guy will essentially they would not own land, they just purely build. So they have essentially become like a foundry. Okay, just like semiconductor TSMC, they build chips for their client, right? So I think a lot of these developers may have a chance to transform their business into a pure contractor, just a construction company. They will not make tons of money. They will make some money, but not tons of money. And I think their margin could compress to on a net basis compared to sort of like a 7 to 8% margin. So in that case, if that's true, if their profit margin is only 7 to 8 on a net basis, they obviously cannot pay double-digit financing costs, right? So what I see after all said and done, in the few years' time, this entire property sector you will not see a lot of double-digit yielder. Instead, the yield level, overall yield level, will come down to a more sustainable sort of 6 to 8% level. But on the other hand, the inherent risk of developer blow up or default will likely to become much less. So much more healthy sector in my view.
I mean, even if we think about, and obviously this is a continuous debate among economists and central bankers still, what is the long-term normal risk-free rate, if it's 100 basis or even 200 basis points over the longer term, I mean, a 6 to 8% nominal yield on something that is far more de-risked than what we see currently is still very, very attractive. It will remain attractive until at some point when Western investors do tap the shoulders and invest into the market more. But given just the pure optics of the sector as a whole, prior to all even this government policy, no one has really at an offshore level invested in this area very much. Gordon, the next question and other questions popped up on my screen as well. So ladies and gentlemen, you'll see the questions box in your panels, and feel free to ask questions, and I'll sort of get Gordon to answer them as we go. And this next question links to the next question I have for you, is has the broader market experienced similar levels of volatility to property developers, and has that impacted the portfolio? Now, the question from the advisor is, how correlated is the movement of the rest of the portfolio against the property exposure, given we've only got 15% exposure, and obviously the fund's unit price has fallen this much? So, has there been, I guess, rounding out that question, has there been contagion to the broader, Chinese debt markets offshore, which is what we're investing in?
No, actually, from what we have seen is that the volatility is only confined to the Chinese property credit only, and it's not even has a large impact on the non-property side of the Chinese credit. So if you're talking about the industrial name, some of this we are actually within our top holding. Those haven't been affected, right? So for example, the renewable energy, the car company and some of the technology company, those haven't really impacted at all, even though they are Chinese credit. And obviously less impact on the other Asian credits as well. So Indonesia, all that hasn't been impacted at all. So this round of volatility is only confined to Chinese property.
Yep. Okay. No, that's good to hear. The next question is, let's talk about how we are contrarian as investors from the perspective of credit research agency ratings. Recently, you forwarded me a very interesting article, which I've shared with some of our clients. The current correction we've seen in the Chinese property bond sector, what role has Western credit rating agencies played in the current movement or mark-to-market movements?
I mean, they're obviously doing their job, right? So, but however, I think one thing to stress is that people always say, rating agency, by their very nature of their job, is to change rating according to what's happened to a particular company. The key is when they move the rating. And as an official publishing agent, they are not allowed to move rating based on rumor. They can only allow to move rating when a rumor becomes a fact, a confirmed fact. Okay, and that's the key difference, because market doesn't trade. Market doesn't wait for a rating agency rating to move before they move the price. Okay, market is forward-looking. They anticipate whether it's a fact or rumors or anything. They move when they hear and see something. Market move. Okay. Unfortunately, rating agency rating action does not operate that way. They need facts. They need to file a memo. They need the black and white, right? So they cannot move rating based on rumors or unconfirmed facts. So therefore, this kind of lag will basically, first of all, create opportunity for active investor, forward-looking investor, try to anticipate this kind of rating agency move. On the contrary, if you look from the other side, you can see that you can see a bond drop 10, 15 points, and situations definitely appears to be deteriorating while the rating agencies still stand by their rating. Okay, so therefore, this kind of lag will create opportunity for active investor.
I mean, as we've seen in terms of our portfolio, rebalancing over the course, especially over the 2021 calendar year thus far. I mean, when the rating agencies were upgrading earlier this year, we started selling.
Correct.
And then, so at the same time, when we are aggressively cutting our exposures, they're doing nothing. When they are aggressively derating bonds, that's a fair call for us to start fishing, right? Because it's sort of a one and all situation. As you know, ratings are falling, there are forced sellers in the market as well.
Correct. Correct.
And that doesn't help. And this is what, and if we're talking about contagion, the contagion of late has really been exacerbated by credit research agencies derating China bonds, which makes
Correct.
the prices fall further, right? Yep.
Correct. So in some cases, some of this rating action actually make the situation worse. So for example, right, a company may have some debt obligation where in which one of the conditions is that if the rating downgraded, this obligation needs to be repaid immediately. Okay, so-called the rating trigger. Okay, if that rating hasn't happened, the company may be okay. But if it did happen, then all of a sudden, a company have a gigantic amount of debt needs to be paid in a very short period of time. Okay, so our job is to look at their debt structure, look at their debt maturity, look at the condition, all this obligation and debt, whether they are tied to any trigger. Now, that's one key thing that we value partners spend a lot of time to analyze and try to anticipate potential impact.
Yeah, yeah. Let's turn to, you know, our portfolio, and let's talk about that, because questions also popped up around with regards to portfolios. I mean, what's your view in terms of, you know, constructing the portfolio? Can you sort of talk through the slide I've put up here and sort of talk to what are you confident in? Let's start with geographical. I mean, we're sort of 60% China, Hong Kong, and pretty much not much anywhere else. So can you sort of talk through that? If we sort of take off the cash and FX hedges, let's call that 20%. I mean, there's basically 20% everywhere else outside of China. So why are we still heavily weighted towards China?
First of all, it's partly because of market structure. Okay, China, Hong Kong, actually China, Hong Kong, Taiwan, Macau, all together, they are basically 60% or above of the entire Asian credit universe. So if wants to invest in Asian credit, there's no way they can escape from Greater China region. Okay, otherwise you might as not putting money at all, because it's simply not meaningful. So therefore, we have to stay invested in China, Greater China credit. You know, if you are committed to doing Asian credit. But as I said, you know, within China, we have dramatically trimmed down on our property exposure. What we have right now is what we believe to be the ultimate survivor in the space. And then we use the proceeds from selling the China property and investing into the so-called industrial or non-property sector in China. So we have position in transportation, logistic company, which basically take advantage of the Chinese economy restart post-COVID, and also take advantage of the current supply chain bottleneck on logistic. We also have position in renewable energy, which is supported by government policy, and also some of the commodity names basically supported by the year-to-date commodity rally. All the commodity right year-to-date has pulled double-digit returns. So all these companies has become quite good in terms of fundamental. So we do have room to steal away from real estate into the non-real estate names in China.
I mean, right now we're holding 18% cash because the hedges are only sort of less than 100 basis points total exposure to the GAV of the fund. Sort of what's your thinking behind holding that much cash at the moment?
It's basically twofold. Number one is obviously for defensive purpose. Now we want to be a little bit more defensive. I think I mentioned to you before that, you know, the way we construct a portfolio versus the payout. You mentioned the 6% per year, right? So the cash yield, based on all the position in our portfolio, the cash yield has always been something like 8% or above. So essentially, I can afford to have, you know, more than 10% of cash at any given time and still be able to maintain the 6% payout. So we basically, given all these, we just want to be a little bit more defensive in the current turmoil, and also basically save up dry powder, to buy good names when the market is bad.
Do you see a lot of opportunities at the moment, given the context that we have 18% cash, or does the 18% cash actually reflect that we're finding it more difficult to find opportunities, or we actually see some further downside that we need to see wash through, or some uncertainty, I guess, that you're waiting to find some certainty on the back of before you start deploying that cash?
Yeah, I mean, that's a good question. As I mentioned, there are names we can buy at very good price. But also when you have this position on your book, it may also cause additional volatility. So we are trying to find a balance, between these two. So our strategy is to basically, we only buy on a down market. So we don't want to chase a rally, which is, by the way, which is nowadays usually fueled by just rumors or some, one particular good headlines, and then the next day it dropped back.
Yep. I mean, if we sort of talking through that dilution of the cash yield, that is solely a reflection of the amount of cash that we hold. Plus, we hold 9% in AAA rated bonds, and as you can see here, 9% is actually this 9% government. It's just US Treasuries, because it's still better off picking up a little bit more than zero than literally zero, because all the bonds that we hold are US dollar base, and that's just, again, a direct reflection of the cash yield, and also a slight reduction to the yield to maturity. So one of the questions that came up, and I think you just answered it, is the portfolio still targeting a 6% income distribution in the current environment? Yes, we are, and Gordon is confident in the names that we bought. The next question we have, Gordon, is what is the attribution of the recent dip in returns? Is it credit spreads widening versus the rise in yields due to inflation concerns? And there was a sort of an extra comment from the same person saying, P.S. I presume it's mostly credit due to the very short-term duration of the portfolio. Yeah, it's predominantly credit spread widening. That basically takes us back to the six standard deviation chart. Yep. That's right. The FX and also the duration, while the contribution has been very little. Yep. The next question is a little bit longer. Okay. The concern is that we're holding 60% in non-investment grade bonds. If there is an equity sell-off, I suspect the bonds of these companies may fall too. I wonder if this is still providing a good alternative to high yielding stocks, as opposed to holding these bonds. Now, to the advisor that asked the question, to be clear, this fund is always been high yield. In actual fact, outside of situations like we see now or March of last year, this fund is 90% plus in high yield bonds, plus some cash waiting for opportunities. And that's sort of been the case of the fund for over the last 10 years. So I guess the question more towards something that Gordon can answer and is actually more relevant is, do you see that, if there is an equity sell-off, that the bonds of these companies may fall too and fall quickly? What's your view on that? That's also a very good question. But first of all, I think when one decides to whether buy bonds or buy stock or buy bonds, it really comes down to one's preference on their asset allocation. These are two very different asset class, and they both have very different risk reward profile. So to your second question is, if equity melt down, whether this bond will drop a lot. To be very honest with you, higher bond will also drop, but also take we need to realize the fact that bond is an obligation to repay. Okay, if a issuer is not a default candidate at maturity, they will have to pay back at par. Okay, this is a simple fact. So therefore, when equity drop, theoretically speaking, they could drop to zero. There's no floor. But as a bond, if you observe bond prices, if a candidate is not a default candidate, then there will be a limit of how low a bond price can go. Okay,
assume a company is not default candidate, they could drop from 100 to 90 or 85, or let's say it dropped to 50, right? During the Lehman crisis, even though there's some very good company, the bond price dropped to 50 because of liquidity, market liquidity. But nonetheless, if these companies are not defaulting and will not default, eventually it will go to par. So we are not looking at no floor. There is a floor of bond prices. So that's very important to remember. That's why I always tell my client, buying bonds, especially buying credit, you need staying power. You need the money to be there, and basically you have to ride through the volatility. And at the end of the day, you will get your 100 back. Yeah, but it may not be the case for stock.
I mean, the standard deviation argument is exactly that, right? We are riding through a level of volatility to get to the back end, which is getting back the principal being paid back at par. So I guess to the question around are dividend, high yielding stocks better? Not necessarily, because the dividends can fluctuate. We can have a scenario like last year where dividends were cut to zero to preserve cash flow. But on bonds, they still have to pay. So you actually got higher levels of certainty from that perspective. So again, it's not whether it's better or worse, it's what you're trying to achieve. And you'll also, I guess the other point to note here is that it's also looking at margin of safety. If you're buying high yield companies, in my opinion at the moment, right, how much margin of safety do you have in terms of potential corrections? I mean, we're looking at, especially US and Australian blue chip, equities are very, very expensive at the moment. Any slight negative news that's going to come on the market will see much more severe corrections. It may bounce up again, as we view back in September, and the bounce back was quite quick because there is no alternative. But at the end of the day, at one point when interest rates rise, and this leads to the next question that someone has asked, you have to consider where you're actually getting a solid, consistent income from, and high yielding stocks doesn't necessarily derive consistent income. It derives income, full stop, but it is volatile in of itself. The next question is, how far are you from going overweight in property? So will you be early to buy, you think? Or are you going to wait for the Chinese government to announce policies to change? Then that's going to give you more confidence to go overweight again. Or not actually, to be fair to the person that asked the question, to be overweight needs to be over 60% of our fund needs to be in property. So I think the question is more, what's going to give you the confidence to buy more property, but still remain underweight, clearly?
I think there's two point of time. One is by the end of the year, and then the second time is it's like maybe March, end of Q1 next year. So by the end of the year, we expect nothing will change. The tightening bias is still there, and then after March, maybe there could be some new policy or relaxation measure, because in March there will be a big government official meeting among the top Chinese leaders, and in that meeting they usually discuss about all the big issue in the macro environment. So I would say in the next till March next year, I think the sector will likely still in the nimble in a way. And valuation will likely to be, kind of fluctuate around the current level. There would be other developer may find themselves into trouble, okay, which is within our expectations. So we'll closely observe the next few months and try to take advantage of it. If we see a really down market one day, we obviously we don't mind deploying some capital, but not large scale to take it all the way up to something like 60%.
Okay, sure. Before I ask, there's one final question that's come up. Something we haven't covered yet is the current position that you hold on the hedge between Aussie dollar and USD. Can you sort of talk us through what are we currently hedged at, and what's your view? Because I guess one of the observations that we've also had is, Gordon, you're trying to use the Aussie US dollar relationship as effectively a volatility buffer of, you know, to sort of smooth out returns and mark-to-market movements. But I guess this time round, because it's so China specific, it hasn't been able to be used as a tool. Now, for everyone on the call, you know how honest we are about these things. You know, when market movements are not in our favor, like we currently are, I mean, this is what's happened. Gordon, can you sort of talk through that in your view?
Yeah, right now I only have about a quarter of the portfolio hedged back into AUD. So that means 75% of the fund is basically unhedged into AUD. And recently the AUD has been depreciating versus the dollar. So that 75%, when you translate AUD back to USD into AUD, you will see some offsets which used to buffer the underlying bond movement. Yeah.
Yeah. Okay. And then at the current moment, you know, 25%, do you see any large tilts from this, you know, movement, or is there any triggers that may make you, you know, tilt it materially?
Not in the near future. Not in the near future. Yeah.
Yeah. The last question that we have here is, could you give us an outlook and potential impact if interest rates rise? And the outlook for China banks and sort of, I guess, the financial system overall. Now, something to put into context is the Chinese risk-free rate is around 300 basis points. It's very different to the rest of the world. And so, you know, maybe given that we're buying US dollar bonds, Gordon, I'll assume the question is, you know, what's the potential impact if US rates rise on our portfolio?
Sure. First of all, I believe that even though the Fed's gonna high interest rate, I believe the impact to this portfolio will be quite minimal because we have always been, as you know, running very low duration. The Premium Asian Income Fund primarily is a fund invest in credit, and interest rate strategy is never our focus, right? And we never say we are interest rate specialists. So therefore, we are credit specialists. We are not interest rate specialists. So therefore, when we construct the portfolio, we do not anticipate any P&L from our interest rate exposure. So therefore, help explain why our duration has always been quite low. At the latest numbers, we are sitting inside 2 years of duration, although the credit duration could be very large. So therefore, I believe that if the Fed eventually going to hike rate, first of all, the impact to this portfolio should be quite minimal. And second of all, is that a consistent rate hike historically has been quite positive for credit, because the reason why is that if the Fed engage in a consistent rate hike, you know, meeting after meeting after meeting, that means obviously the US economy is doing quite okay. And that also implies the rest of the world will likely be okay, right? So therefore, the business environment overall should be much better than we are today, okay? So a business environment will allow companies to make more money, to be more profitable. So therefore, that will eventually translate to tighter credit spread, because when the company fundamental improve, investors will naturally require less credit premium to own certain issues. So therefore, a slowly rising global interest rate environment is actually beneficial to credit investment, including our investment. So this will have some offset effect to the interest rate shock, whether our duration is 2 years or 4 years. Yeah, and this credit compression usually comes in amount bigger than the rate hike. Yep.
Excellent. I'm just going to launch final thing just to remind everybody our TMDs. So after this presentation, you'll receive a copy of this deck, and in every presentation going forward, as you know, with the TMD, or sorry, the DDO regime, all the latest TMDs are located in our presentation and the direct links to it. There are no distribution conditions on any of our funds, which we're very, very happy with. And furthermore, if there is any further questions you'd like to ask or anything that wasn't covered off today, you can see on the screen there me and Derek's details for more information. As I said, this is recorded. You will receive a recording of this, so if you'd like to share it with your colleagues or other advisors that you know that will benefit from information shared today, please feel free to reach out. Yeah, with that, thank you very much, Gordon, for your time. I know it's very, very precious, but I think it was very, very worthwhile to spend an hour with us talking through the issues. And on everyone on the call today, if I don't speak with you, any of you prior to Christmas and New Year, I wish you a very happy festive season and look forward to catching up with you all in 2022. And with that, I wish everyone a good afternoon. Thank you.
Thank you.